All right, welcome. Thanks to everyone who's joining us live. We have a very timely discussion today on the topics of gold, inflation, and an outlook on the global economy with an emphasis on the United States. I'll be your panel moderator today. My name is Andrew Swan. I'm the CEO of IDX, a US-based quantitative research firm and asset manager. And I'm very fortunate to be joined today by both a tenured and talented group of panel speakers. Starting with, but in no particular order, Dennis Gartman, the founder and editor-in-chief of the Gartman Letter, a well-respected and well-followed industry publication that's been around for the last 35 years. We also have Marcus Frampton, the chief investment officer of the Alaska Permanent Fund, a $68 billion sovereign wealth fund based in Juneau, Alaska. We next have Pooja Sriram, a US economist with Barclays based in New York. Next up is Don Robinson, the former founder of Lockwood Advisors and the current founder and CEO of Palladium, an institutional OCIO based in Philadelphia, Pennsylvania. And last but certainly not least, we have Ben McMillan, the founder and chief investment officer of IDX. And thank you to all of you for joining us. We're really looking forward to the discussion. Now, before we dive in, it is requisite that we state the obligatory disclosures. This presentation has been provided solely for informational purposes and does not constitute an offer or solicitation of an offer or any advice or recommendation regarding the purchase of any securities or other financial instruments and may not be construed as such. The information contained herein may contain hypothetical performance data. Hypothetical or model performance data results may have certain limitations. For example, hypothetical results do not take into account actual trading and market factors such as liquidity disruptions. IDX indexes are available only through third-party investable instruments based on that index. IDX does not recommend, endorse, approve, or otherwise express any opinion regarding any issuer, securities, financial products, or other instruments or trading strategies. All material contained herein is intended for informational purposes only and should not be construed as legal, accounting, tax, investment, or other professional advice. Well, as you can see, we have a pretty full agenda today, and I'm going to do my best to guide us through these topics for the next hour, starting with an outlook on the COVID pandemic and its impact on both the United States as well as the global economy. We'll look at trade policy such as U.S. protectionism and its go-forward impact on inflation, as well as expansionary monetary and fiscal policy and their go-forward impact on inflation and reserve currencies. We'll then turn to portfolio construction and talk about the potential paradigm shift towards inflation and or a weakening dollar. And we'll look at alternative asset classes that have historically provided a reprieve from inflation and preserved purchasing power, such as gold and the precious metals complex. And lastly, we'll try to wrap up with some concepts around managing the unique volatility of gold within an asset allocation mix. So without further ado, Pooja, perhaps you can kick us off for the next few minutes by discussing Barclays' nearer-term economic outlook.
Hello, everyone. My name is Pooja Sriram, and I am a U.S. economist with Barclays in New York. What I'll try to do today is present Barclays' views on where we see the U.S. economy, our near-term outlook, as well as risks in the horizon. So a good starting point for us would be to try and understand how the global economy looks currently. So the first half of 2020 was clearly a difficult period for most countries, with the coronavirus outbreak starting in China in the first quarter and eventually progressing to other parts of the world. It was clearly disruptive both to real economic activity as well as financial markets. So within Barclays, for the full year, we see global growth declining by about 3.5% to 4% in 2020. But the good news is we do see a fairly quick recovery in 2021. But I guess the main question here is what leads us to be so optimistic about the recovery in 2021, especially given that we've seen a resurgence of COVID-19 cases, just over the past month. So I guess one thing that we've seen, and which is proven to be very helpful, is expansionary fiscal policy world over. And in the US in specific, we've had a fairly substantial package rolled out. I think one of the biggest ones was the CARES Act, which provided substantial assistance to both households as well as businesses, which has helped support the recovery so far. Other than fiscal policy, I think what's also proven to be very effective is how promptly monetary policy responded globally and in particular in the US. I think just to quickly recall, we had what we call emergency Fed meetings sometime in mid-March as soon as they realized that the virus was getting out of control. We, of course, had the federal funds target range come down to 0 to 0.25%. But over and above that, I think the Fed did a wonderful job in terms of rolling out several measures to support financial market liquidity to try and get financial markets back on track. So in our view, both fiscal as well as monetary policy have played a very substantial role in trying to get the US economy back on track after the slump in sometime in late March and April. The question is that, with activity seemingly rebounding in May, June, July, how do we see the economy progressing here on? Our baseline outlook is that we see growth in the third quarter rebounding by nearly 20% on a quarter-on-quarter annualized basis, given that Q2 GDP fell by 32.9% in the second quarter. So we do see a rebound in the third quarter. We see a more modest number in the fourth quarter. But despite that, like I mentioned earlier, full year growth is still likely to be down about 5%. And what would be the sources of a positive growth in the third quarter? In our view, it's likely to be primarily consumption spending. Households so far have seemingly been willing to spend. They, of course, had the additional buffer from the income they accumulated with government assistance, in the previous months. And they seem to be willing to spend, and household balance sheets look fairly healthy. So if that continues, consumption spending should be a driver of growth going forward. And if that happens, it should hopefully lead to a virtuous cycle of production picking up, generating more employment growth and so forth. So that's, in our view, that's like a best case scenario. But of course, the crucial factor here is what does the virus do? So we've been tracking the development of virus cases across the major regions of the US. The good sign is, after having peaked somewhere in July, cases excluding the northeast of US seem to be on a downward trajectory. We're also tracking COVID cases on a regular basis, and the numbers are much lower than what they were, say, in mid-July. So that's a good sign. But it's really to be seen whether this sort of the space of recovery continues. If, for whatever reason, virus cases remain elevated, for example, it's only going to take that much time for the economy to come back on its feet. So clearly, the virus remains the major risk on our horizon. And I guess the other thing that we are worried about is also whether there is additional fiscal stimulus from the government. As we mentioned, whatever was rolled out via the CARES package proved to be very essential in getting this recovery going. But now we don't have a so-called phase 4 stimulus yet. So it's imperative that there is some additional package that is rolled out to support households as well as small businesses. Because absent that, we do see some risk to consumer spending in the months ahead. And I'll just quickly turn to policy here. We've spoken quite a bit about fiscal policy and the role that it's played and the fact that we need more. Turning to monetary policy, I think we're at a very interesting time. So while the Federal Reserve has done, pretty much everything it could in terms of using its toolkit to support the economy, the question that we hear a lot and the question that we ourselves have is, what more can it do? So as far as our near-term assessment is concerned, we do see rates being on hold through at least 2022. And that's constantly the kind of message that we've also seen in the FOMC minutes, where we've made it very clear that unless we see signs of a recovery and unless the Federal Reserve is comfortable raising rates, it's not going to go in that direction. So in our view, I think 2022 is perhaps a very convenient time period till which they're likely to keep rates on hold. I think the other thing that's interesting is the policy framework review that the Fed is currently undertaking. Powell's signal that we've got from the FOMC minutes has been that they aren't very keen on any sort of yield curve control. What they're definitely considering is some sort of an average inflation targeted framework, which will allow them to be comfortable about inflation overshooting for a certain period of time before it comes back to, say, the 2% level, which would remain as their inflation target. And which brings us quite nicely to the topic of inflation itself. In terms of measuring, I think what we have understood is the PCE measure is likely to stay as is, primarily because the basket of goods in PCE sort of, represents consumer spending and demand more accurately than the CPI basket. So it's quite likely that they don't change that, and that remains the reference point. In terms of how they average it, the feeling that we get is it may not be symmetric, in the sense that with inflation being such a struggle for it to come up to 2%, it's quite likely that we will be more comfortable with it overshooting for a longer period of time. Whereas, we might choose a shorter time frame for the undershoot. So it could be that they employ a very asymmetric approach to it just to sort of, find ways to get it to that 2% level. And if they're able to convince markets about it, for example, then the market should eventually learn to be comfortable if, say, inflation is at 2.2%. Going forward, we still think this demand story is likely to be more dominant. Within our own forecast, we see inflation picking up to the 2% level only sometime late next year. Which means that we still have a long way to go before we reach the sort of levels that we were at in 2019, which also goes to say that demand has a long way to recover. And I guess finally, the other more long-term aspect or question that we don't have any answer to per se, but something that we have been thinking about is, does an episode like a pandemic also somewhere change the global structure of the economy? So this goes back to, say, the end of 2019 when we had US-China trade tensions. That's something that we haven't been talking about, and that seems to have been forgotten. It's only in recent days that we're reading headlines about, some of that tension coming back. But we were probably already in a phase where we were considering deglobalizing. So that's, I guess, something that is a possibility. Whether there are potential structural changes to the economy and we choose to become more protected and more closed, uh, especially after such an episode, which ended up transferring from country to country. But like I said, that's a thought for much later. In the near term, I guess the focus would be on what the virus does, um, the pace at which activity manages to recover, and what signals we get from both monetary as well as fiscal policy.
Thanks, Pooja. That was very helpful. And following Chairman Powell's speech at the Jackson Hole Virtual Summit last Thursday, it makes sense that so long as COVID stays within bounds and monetary authorities continue to be stimulative, that a recovery can play out over the course of the next year. However, I'd like to zoom out and discuss your last point, which was that structural global change as a result of the pandemic is a possibility. And I think that's important because the decisions being made in the years ahead might affect several generations to come. And with the US Fed adopting a new monetary policy framework, essentially inflation averaging, where we should expect to overshoot inflation targets for a duration of time without adjustments to rates, can bring about interesting implications not seen in relatively recent history. One of those implications being global trade. And like your graph shows, since the 1980s period of hyperglobalization, inflationary pressures have been virtually non existent. Fueled by technological advancement and the export of manufacturing jobs to low-wage countries, particularly China, deflationary tides and downward trending interest rates have dominated the narrative. But now, with heightened global economic strain to supply chains, uncertainty surrounding COVID resurgence, and a growing lack of trust between the US and China in general, is protectionism and deglobalization going to be the dominant trend going forward? And Dennis, you've covered a lot of these topics at great length throughout your career, and you're a lifelong student of history. How do you make sense of what lies ahead?
Yeah, I think the benefit has been globalization. We brought enormous numbers of workers around the world into the global labor market, and that has driven wage rates or kept wage rates extremely low. But given the propensities around the world, whether it's here in the United States, whether it's in England, whether it's in Europe, whether it's in China, I think there's a marked and sad propensity to become trade protectionist everywhere around the world. I will probably vote for Mr. Trump, but I take some of his actions as trade protectionist circumstances as being economically stupid beyond belief. The raising of tariffs is stupid beyond belief. And his movement towards trying to make sure that everything is manufactured here in the United States, which an idea that sells to the public and sounds quite nice, but to bring everything back home to the United States when instead of having an automobile manufactured by a Mexican worker at $5 an hour instead of an American worker at $75 an hour, or to have your shirts manufactured in the United States at $25 an hour when you can have it done by a Chinese laborer at $3 an hour. That sort of circumstance is going to give rise to inflationary pressures, no question about it. So my great fear is this driving motive force towards trade protection everywhere. We are the leader in that field right now, which is very sad and very discouraging to me. But I think given the fact that the monetary authorities have been as expansionary as they have been, and this driving direction towards trade protection, given the fact that crude oil has rebounded from, call it, negative $35 a barrel up to $45 and $50 a barrel, given the fact that the grain markets are starting to turn around and move higher, given the fact that the gold market has soared to the upside, given the fact that livestock prices are now beginning to move from the lower left to the upper right, given the strength in the tin market, given the strength in the copper market, given the strength in the industrial precious metals, silver and platinum and palladium, looking across all, and given the astonishing rise in lumber prices from what, $200 or $300 per 100,000 board feet to $600 per 100,000 board feet in the course of the last 2 months. Something is happening in the commodity markets that nobody is paying much attention to, and that's inflationary beyond belief. Watch what the bond market is doing. Watch the long end of the yield curve. You're breaking uptrend lines in the long bond that I think are very serious and very important. So I think inflationary pressures are about to become extant, very obvious. And once that starts, it's years in the making. So this is a change. We've had 25 years of deflationary pressures because of the expansion of globalization. Now we're contracting globalization, and that can only be deleterious. That can only be supportive of inflation, deleterious of the disinflationary circumstances that have prevailed.
So, Dennis, when I think about inflation in anecdotal terms, I often reference a tsunami or a tidal wave because typically there's a seismic shift, or in this case, a paradigm shift, which sends ripples all around the world. And eventually it crashes upon the nearest shore. And the interesting thing is that if you sat far enough offshore in a boat in deep enough water, I'm talking thousands of feet deep, the tsunami would pass you by at 500 miles an hour, and chances are you'd probably be none the wiser. And I feel like we have the potential to be sitting in that boat today. So, my question for you is, given that we've been in a fiat currency system since August 15th, 1971, which has undoubtedly allowed for a much larger and more prolonged debt cycle, we also have a rising global power in China. At what point do we risk discrediting the dollar status as the world's reserve currency? How far can we take interest rate suppression and money printing?
As long as the monetary authorities remain expansionary, and given the fact that the global economy is in, for lack of a better term, certainly a recession and probably a depression. When we look back at it from 5 years hence and look back at today, we'll say yes, that was a self or an induced depression that the world had gone through. Monetary authorities have no choice; they have to remain as expansionary as they have been, and maybe even more so. The not only just have the monetary authorities have to remain expansionary, but the fiscal authorities have to be even more so, more aggressive. So we're going to see that here in the United States. You asked a question about reserve currency status, and the question was about China. There's no question. I'm going to be 70 years old, so I'm probably in my last. I'm in the seventh inning of trading here. But when extra innings come in 25 years, is the Chinese renminbi likely going to be a rival of the United States dollar as far as reserve currency status is concerned? Almost certainly. There's nobody else around in the world that's going to be. I don't see the euro being a real competitor of the United States as far as reserve currency status is concerned, but the Chinese renminbi shall be. Let's talk about reserve currency status because I think it's very important. And who does reserve currency status always and everywhere inure to over the centuries? It always goes to the strongest military power. And more importantly, it goes to the strongest naval power. Going back to the 15th or 16th century, Portugal, for a period of time when it was the strongest navy in the world, was the reserve currency was the reserve currency of the modern world at that time. Finally, Spain, with a better navy, became the next reserve currency. For 300 years or however, as the British after the Spanish Armada was defeated, Britain was and remained the reserve currency for 300 years until after the end of World War II. When it ceased to be the dominant military power and certainly ceased to be the dominant naval power. The United States is, without equivocation, the dominant military and naval power in the world. We have 10, sometimes 11 aircraft carriers. Depends on which one is in Newport News being refitted or refueled. But behind us, as far as the aircraft carriers are concerned, and they are real manifestations of power. That's how you exercise power around the world. Is moving your aircraft carrier and your 16 attendant ships that go with her. Then the next behind us is Italy with 2. England has 2. China has 1.5 and a second one coming. China will have 3 or 4 or 5 in another 25 years. And when they do, they will cease to be a littoral naval power and become a blue water naval power. But that's decades into the future. And we shouldn't have to worry about that for the next 2 or 3 or 4 or 5 years, maybe even a decade or so. We will remain the reserve currency of the world. And as long as we do, that will be the one inhibiting factor on the gold market. The strong dollar was always and everywhere inhibiting of rising prices for gold. And we're going to continue to be the world's reserve currency for a long period of time going forward. But that will change long after I'm dead.
Yeah, that's a very interesting point. The correlation between the world's largest naval power and reserve currency status, and probably a point not commonly known. And you mentioned forces acting on gold, which I do want to get into before I go too far down the rabbit hole. But we've been talking about risks, particularly inflation risks. And another hot topic is geopolitical risk. And like it or not, we are currently in an economic war with China. And you've been a thought leader on China and the geopolitical landscape for well over a decade now. So I'd be remiss if I didn't ask, what keeps you up at night?
I wake up every morning when I was writing the newsletter. I would wake up every morning, and the first thing I would look at was, did India and China, did India and Pakistan go at war with one another in the high Himalayan Kush? That will always be the first thing that I check in the morning to see if India and Pakistan have fought it with each other, if India and China have fought with each other. India and Pakistan have been having border skirmishes for years. India and China had a border skirmish 4 weeks ago. And the reason why I worry about it is because all three of those countries are nuclear powered and have small nuclear capabilities. You don't have to have missiles. All you have to have is the ability to fire cannon at one another with a nuclear warhead. And I worry about that. That keeps me up at night. And every day when I wake up and find out that they haven't fired off at one another, that some hothead has not gone off half cocked and started World War III, I breathe a sigh of relief and say, well, okay, we can go on to other concerns. But that's the thing that keeps me up. Secondly, I then watch to see what has China done in the South China Sea. Have they become even more expansionary? I've been writing about that for 15 years. And when I first started writing about China becoming expansionary in the South China Sea, people said, why are you worried? Well, now they know why I'm worried. China is clearly flexing its muscles, and it intends to flex its muscles for a long period of time. It feels like it had suffered for the last 100 years, and it is flexing its muscles in the South China Sea. It's flexing its muscles in the high Hindu Kush. The fact that they now have a naval station in Djibouti, which take a look at a map on Djibouti, well, I think one of the most important countries in the world that people pay no attention to. It is the guardian country on the south border of the Suez Canal, and they have a military. They have a large military and naval position there. China intends to become a far more dominant power. As I said, thus far for centuries, it has been a littoral naval power. It intends to become a blue water naval power, and we have to pay attention to that fact. And finally, I'm worried about China doing something untoward to Taiwan, and what does the United States have to do if the Chinese were to launch an attack against Taiwan to bring Taiwan back into its embrace? Those are the things that keep me awake at night.
So, Dennis, what does this all mean for the gold market, in your opinion?
Well, first of all, let's understand that it is a bull market in gold. It has been a bull market in gold. It's going to continue to be a bull market in gold. I am not a gold bug. Gold bugs are always and everywhere bullish of gold. No matter what happens, when gold goes down, they're bullish. When gold goes up, they're bullish. When gold goes sideways, the gold bugs are bullish. There are times when one is to be bullish of gold. There are times when one is not to be bullish of gold. There are times when one is to be bearish of gold. But this is a time when one is to be bullish of gold. It is a bull market, and it's going to continue, I think, for several years. What is driving gold? And it's one thing. Monetary authorities are expansionary. It doesn't matter whether it's the Fed. Doesn't matter whether it's the Bank of Canada, doesn't matter whether it's the ECB, the Bank of England, the People's Bank of China, the Bank of Russia. Everybody everywhere is expanding monetary reserves at an egregious pace, and that's not going to change anytime soon. And as long as that continues, gold is going to go from the lower left to the upper right. Would I be surprised by $3,000 an ounce by the end of this year? No, I would not be surprised at all. As I've always said, in a bull market, there are three positions one can have: really bullish, modestly bullish, or neutral. And after the correction that we had, I'm back to being modestly bullish, and my intention is to become aggressively bullish in the not too distant future.
Yeah, we're definitely seeing the long-term uptrend in gold as well. And I'd be curious, with the macro setup looking the way it is, and with interest rates at historical lows, how is all of this influencing your own personal portfolio allocation?
One has to ask oneself, with the long bond, with the 30-year bond yielding 1.5%, and I've always said in every speech that I've ever given that all economics is the study of people's propensity to take some sort of action. What's your propensity to put money to work even for the United States for 30 years at 1.5%. I have to think it's probably relatively limited. And so I think I think that's going to be the big change, is the rising level of interest rates, the declining number of levels of the bond market, the rising level of rates at the long end, and everywhere except the short end, because the Fed clearly is going to keep the overnight Fed funds rate at or near zero for the next year or two at least. But they don't, and they can control what happens between, let's say, 6 months and under. But the Fed begins to lose control after 5 years, and they have very little control whatsoever at the long end of the curve. And the long end of the curve is starting to show signs of deterioration. So I think pay attention to what's happening there. So you were asking me. I apologize for getting back into it. So what am I doing? In my own account as of this afternoon, and for the last week and a half or 2 weeks, and I think I'm going to add to it, I'm short the long end of the curve, and I'm long the gold market. I'm the only thing that I'm other than that I have on is I'm long a lot of high yield monthly dividend paying shares that on an annual basis yield 6, 7, 8, 9, 10%. And when they give it to you on a monthly return, that helps a lot. So I'm long high yield monthly dividend payers. I'm long gold again, as of gold and silver as of yesterday afternoon, and ready to add to it, to add more. And I'm short the long end of the yield curve. And that's my own money at risk.
What about the risks a financial advisor faces going forward, or a retiree for that matter? When you look at the last 40 years, the conventional norm has been 60-40 portfolios, and a lot of that's due in part to declining interest rates. What guidance do you have to someone looking to ultimately achieve that same 60-40 style risk return profile in the years ahead?
I think given if we start from the notion of having a 60-40 stock versus bond split, probably what you should do is make it 40 and 40 bonds, stocks, and 20% in inflationary hedges, predominantly gold. So instead of 60-40 bonds versus stocks, 40 bonds, 40 stocks, and 20% gold. And I think that will do a lot of, that will benefit you in what I think is going to be happening over the course of the next several years. Do I want to, and if I had to change anything at all in that, rather than 40-40-20, I'd make it 40% stocks, 30% bonds, and 30% gold if I had to get more aggressive on that, because I'm very concerned about the bond market at this point. You have to, at these levels of rates, the value of an 01, when the bond market, when the long end of the bond market moves 1 or 2 basis points, the price movement is rather egregious in nature. And so the losses can accrue relatively quickly. And if I can see the long bond at a 1.5% yield going to 2.5 or 3 or 4 or 5 in the course of the next 5 years, if you held too many of the long bond, the losses that you would suffer on the value of your portfolio would be, rather extensive. So I think perhaps 40-40-20 or 40-30-30 is probably the way to go. 40% stocks, 30% bonds, 30% gold until further notice.
Thanks, Dennis. Marcus, I'd like to transition the conversation to institutional portfolio management and, most importantly, risk management. You run one of the largest funds in the world in Alaska Permanent Fund, and you undoubtedly have some pretty heavy responsibility when it comes to risk management, income generation, preservation of capital. So when you look at what's going on in the world, how is all of this informing your decision making?
Yeah, sure. So our fund is $68 billion. It's the oil sovereign wealth fund for the state of Alaska. We, like many endowments, and probably like many retirees living off of an income, need to target a certain distribution out of the portfolio to the state, which is used for state operations and a dividend. Our board and policymakers in the state have selected a 5% spending rule, which I think is fairly common. Unfortunately, it's difficult to achieve a 5% return without taking too much risk in the market today. And actually, our investment objective is CPI plus 5. So we try to grow the fund corpus with inflation and then spend 5%. So now that's 7%, which is similar to the actuarial returns of pension funds. My observation would be that a traditional portfolio, 60/40, would be quite unlikely to earn a 7% return over the next decade. Um, I think the Shiller PE is probably the best metric for estimating a 10-year return on stocks, and where we are today on that would probably indicate a low single-digit return. Interest rates are where they are. 10-year Treasury under 1%. So, faced with that setup, I think most people in the institutional or state fund world have chosen to increase risk, most notably through private equity allocations and equity in general allocations going up. I think that's a mistake that people make. I think it's difficult to time markets, but when you're in an environment with a low expected return, on the margin, you should be trying to de-risk your portfolio, not risk it up, and then put on risk in a different environment. So I've had a big emphasis on hedge funds, zero beta hedge funds, CTAs, macro funds, and then gold is our latest allocation that we're looking to bring into the portfolio for a number of reasons that I'm sure we'll touch on this discussion. But it fits with the theme of wanting a little bit less risk on the margin given the environment.
Well, let's talk about some of those reasons. You and I have discussed the merits of having gold in an asset allocation mix, and I'm sure some of the listeners would be surprised to know that it's actually been a fairly difficult allocation to get into the total portfolio, and there's been some opposition. What do you think it is about now that's changing the mind of your investment committee?
Yeah, I mean, we've had pretty extensive discussions with our board over the past year, and it's been frustrating to see the price of gold go up as we're having these discussions. But one of the reasons why it's been a lengthy discussion is that it's sort of an unconventional investment in the institutional world, in spite of being one of the most time-tested stores of value. So, at the same meeting in May where I, thought we were doing our final proposal on gold only to have it deferred to September, we were approving a $2 billion annual allocation to private equity, which is less time tested than gold and higher risk than gold. But I think the deliberate nature of getting into a new area makes sense, and for a state fund like us, and the track record unfortunately has not been good on state funds getting involved in gold. So UTIMCO, the Texas endowment system, very famously put on a gold allocation in 2011. Lesser known, but further in the past, the Alaska pension system in 1980 put a gold allocation on and lost, I believe, several $100 million. So it's those kind of timing issues that I think caused some hesitation with some of our board members. And, I'm well aware of that. It doesn't change my views. I mean, you need to learn it. I mean, I don't believe that I don't have a price target like Dennis Gartman does for gold. And in fact, for me, it's less of a appreciation opportunity and more of a risk, uncorrelated asset, uncorrelated liquid place to have some money. I think the setup's great for gold with it being under-owned in the institutional world and with the money printing that's going on. So I think there's a real case to the upside from here. But for me, it's more of probably a fixed income or a hedge fund substitute type product to have in the portfolio.
Yeah, and that's a point that shouldn't be readily overlooked. When you're evaluating things like gold, it's not simply about the upside capture or the return opportunity. A big part is the true diversification, particularly from stocks and bonds during periods of stress. And given everything we've discussed today, that's only becoming more relevant. Marcus, I think something that would be interesting, if it's fair play, would be to understand how you've positioned yourself as an institutional asset allocator. Like we've talked about, you have a very large portfolio to put to work, and I'm sure it includes more alternatives in uncorrelated assets than most. But Would you mind sharing some insight to the listeners today about how you're currently positioned?
Yeah, sure. So today, our fund is about 40% in public stocks, 20% in fixed income, and then the remaining 40% are various types of alternatives, ranging from real estate, private equity, hedge funds, et cetera. And I think that we've probably mirrored the trend in our industry. If you go back to the early 1980s when we were just getting started, we were all investment grade fixed income. Then at some point we added real estate in the 80s and stocks in the 90s. And in the early 2000s, we added alternatives. And our return objective hasn't really changed over that period of time. It's just in the early 80s you could earn a high single digit return in fixed income. And so everyone's over the last 30 years has been pushed out the risk spectrum to keep hitting, a 7-8% return. And it would have been better to be inverse. It would have been better to have a big private equity portfolio in 1984 when no one was doing it. And that's one of the frustrating realities of 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 needing to hit a certain return. And then also, I think there's a tendency to do what your peers are doing. And I think Warren Buffett has a great quote that what begins as a great idea in the end a fool does. So things have a way of, and I have some concern about private equity from that standpoint. But that's our mix of assets, and we're trying to get more and more balanced. I am, and add some uncorrelated assets. So we've been growing hedge funds, like I said, and I want to add gold. But in terms of looking at the history of these markets, it is really tough to analyze because we've had this mega trend of lowering interest rates over time, and it's well known that people have a tendency to over focus on the most recent time period. So coming out of the Depression, everyone wanted very high quality, low risk portfolios, and we're kind of at the other end of the spectrum now, I would say, in terms of people's reaction to markets and risk.
That brings another Warren Buffett quote to mind, which is, be greedy when others are fearful and fearful when others are greedy. Don, I'd like to get your take. You manage a very sophisticated client base ranging anywhere from multifamily office money to small sovereign wealth funds, charitable organizations, religious foundations. When you take into account what we're discussing and other things you might be seeing in the world, how are you positioning Palladium? How are you managing risk? What does the portfolio look like today?
Sure. I think, I agree with Marcus in terms of traditional fundamentals are really not good when you look at fixed income or equity. So it doesn't really leave the investor with much else. So I would say near term, we're very bullish on uncertainty, which sounds perverse, but I think because of that, you want to be in things like hard assets, tangible assets, such as gold or precious metals. We think there'll be a lot of disruption what you're seeing it already in the job market, the economy. What does that mean? I think probably a lot of volatility in the public markets, equities and bonds. We have negative real yield, so there's nowhere to go. You still have a lot of investors just blindly reaching for return without really understanding the underlying risk. Why are people piling into equities? Because there's nowhere else to go. Why are they piling into high yield bonds? Nowhere else to go. Pretty risky right now with valuations at 30 times earnings in equities, and and like I said, real yields are negative, and you have a record number of companies filing for bankruptcy, especially in the energy space. So I can go on and on and on, but out of all this disruption, we think, so where we're investing is in hard assets, obviously working with you guys. We're big believers. We're really interested in the volatility side of things in terms of risk management because things are volatile. So I think if you have a discipline in terms of managing that volatility while getting exposure to some of these assets is the best thing for the client. We also are big fans of what I call innovation. We started positioning a lot of our equity portfolios 4 years ago on a thematic basis in various technologies such as digital printing, gene technology, immunotherapies, on and on and on. Because out of all this disruption, you get new technologies, and we're seeing it now. Look at what's happened with cloud computing. Look at what's happened with, and I can go on and on and on. So I think you want to have your equity exposure in innovation. We like gold. We like Bitcoin. We like, as long as you understand the volatility characteristics of those assets and you know how to manage that, which is the right way to approach it with clients. So what keeps me up at night is probably the bigger things like the equity income gap, which could lead to social unrest. I don't think it doesn't matter in my view whether Trump wins or Biden wins. I don't think it really matters. I think if people are hungry and they can't eat, it becomes a problem. In terms of geopolitical risk, I would be more concerned about cyber warfare. I'm more concerned not about what we would know as a World War III, but sort of the infrastructure, the grid, things that could really have a major impact across the globe, especially here in the U.S. So those are the things that keep me up at night. But, it's hard to get diversified when everything is moving in the same direction. That's why we started looking at things like gold, risk-managed golds, crypto, risk-managed crypto, innovation, even though it may be moving with the equity markets. So those are the things you have to consider, I think, because of correlations moving to one and negative real yields. So that's kind of our view of the world.
Thank you, Don. Ben, is there any color you would add in addition to that?
Yeah, I mean, I can jump in and just echo. I mean, both the point that Don and Marcus had made earlier about gold, for example, being somewhat of an unconventional asset, despite the fact that it's well known as a store of value. A lot of people, both retail and institutional alike, just in their investing lifetimes, haven't necessarily really considered what a durable allocation to something like gold or even commodities for that matter, let alone Bitcoin, might look like. And I think now people are kind of forced into really thinking about how to fit this into a 60-40 portfolio or what have you, and what does sizing look like, because it is just, to Marcus's point, I mean, the public equity space, the active to passive migration that we've seen, in the last 10 years, really accelerated by the ETF landscape, has just, forced these, kind of phenomenal distortions. I mean, the FANG effect is in large part, driven by that, kind of implicit momentum on the back of these ETF flows. And there's really interesting research out there about, the kind of indiscriminate buying coming from just all these 401ks that are just, because they're buying all these passive vehicles, it's, structurally, that means they're just buying, the top market cap weighted stocks, because most indices are in fact market cap weighted, irrespective of price. And so that leaves, a lot of segments uncovered. I think that's one of the reasons too, you're starting to see people talk about, the value of active management coming back, because there are presumably going to be opportunities in other asset classes, like private credit or other parts of the public equity spectrum. And again, things like commodities and gold, which have been sleepy for a while. A lot of people haven't really considered them, and now they're being forced to think about it, because there's public equities and fixed income have really gotten bid up.
Yeah, well, there's definitely consensus that volatility, risk, and uncertainty are here to stay, and they're probably here to stay for some time. And it's not just stocks and bonds that are inherently volatile. When you look at gold as well, it's got periods of extreme volatility. In the last month alone, there was a very rapid near 8% sell off. And that really starts to approach uncomfortable territory for a lot of investors. So, Ben, as a data scientist and a quantitative investor, how do you approach taming that volatility?
Yeah, that's actually an excellent point that, frankly, we think is lost on a lot of people these days that are getting excited about the idea of gold as an asset class or newer asset class and kind of more traditional portfolio constructs. But it's an important one, and frankly, it's a crucial one to be cognizant of because it's not without volatility and risk of principal loss. I mean, the point you just made about, even just a month ago, there was a very rapid, meaningful drawdown in gold. If you look back, over the last decade, gold's been in a 40% plus drawdown, and so that's real. That can't be ignored in the context of kind of prudent portfolio construction. And so traditionally, people have either just sized those positions smaller within their portfolios, or they've sought to have a risk managed approach generally through active managers in the macro space. We kind of looked at it and thought that there was a void in a risk managed, rules based, transparent, investable index, which was the genesis for us creating our risk managed gold index.
Well, Ben, we have a few minutes left, so why don't we bring it home by discussing the methodology and construction process behind that index?
Yeah, so in terms of kind of how we think about that process and how we approach it, and what we believe to be a robust, prudent fashion, we look at the existing academic and empirical evidence for what has historically done well or worked well on volatile asset classes, and momentum is kind of the obvious candidate. There's plenty of research out there demonstrating the ability for rules-based momentum approaches to kind of create these convex payoff profiles. And that opportunity set is actually most pronounced for more volatile asset classes. So the volatility you can think of as kind of the raw material through which a rules-based momentum approach can ply its trade. And so, for example, if we kind of, to use an analogy, think about an old story that Warren Buffett is fond of saying about gold. If you owned all the gold in the world, you'd basically have a cube that could fit inside the infield of a baseball diamond, but all it would do is just sit there. So if we use that cube as kind of our analogy, in the long-only space, if you have a long-only allocation to gold, you're owning, that cube all the time through all periods, irrespective of what the market might be telling you. What's interesting in particular about gold is because of the nature of the asset class and the supply and demand drivers, sentiment plays a larger role than it does in other asset classes like equities or fixed income. And so gold, we believe, is actually particularly well suited to leveraging a momentum approach to kind of risk manage the payoff profile. And so if you think about that gold, you don't necessarily want to own, that cube all the time and be exposed to all that risk, both compensated and uncompensated. So if we think about a pure long-only allocation as basically representing 100% of that cube, meaning you've got 100% exposure to gold all the time through all environments, the first part of a risk-managed approach is, well, we don't necessarily want to own gold 100% of the time. Let's just take those times when momentum is positive. So that's some subset of our cube, some subset of our time in market, and that's roughly going to be half the time. So we can avoid 50% of the exposure to gold, but actually in doing so, we can mitigate a lot of the volatility. We can mitigate a lot of the drawdown. Now, historically, you'll sacrifice some of the upside, but what you'll get is an asymmetric payoff profile. So you'll get better gain to loss ratios or better upside downside capture relative to a long only allocation. Well, it doesn't have to stop there. So if you take the second derivative of momentum, and in fact, there was actually just recently a paper a couple of months ago from some Princeton researchers about what's known as these interaction effects. And one of which they document is momentum with its second derivative, change of momentum, or you can think of it as acceleration. So let's look at that in isolation. If you just take the periods of time in which momentum is accelerating, so again, that's going to put you in the market roughly half the time. It's going to be a different period of time than pure momentum. The dependencies are a little bit different. It's also going to create an asymmetric payoff profile. It's going to mitigate your risk, mitigate your drawdown. So finally, when we think about combining both of these effects, momentum and its first derivative, the acceleration of momentum, the interaction effect demonstrates much higher convexity, which as a risk manager starts to become your best friend. You're now monetizing that volatility as opposed to being penalized by it. And that's exactly what we're seeking to do in a rules-based, transparent fashion with our Risk Managed Gold Index, is to combine momentum and acceleration in a way that provides that convex payout profile with low volatility, low drawdown. So to ultimately just give another tool in the toolkit for people that are interested, for investors that are interested in getting exposure to gold, but for which a long-only allocation just simply has too much risk or too high a probability of loss of principal over time.
Awesome. That was a great way to close out. Thanks, Ben. And thanks everyone who joined. I certainly hope you enjoyed today's discussion. But before you leave, we do have a live Q&A with our guest speakers coming up in the next couple of minutes. And in the meantime, if you were interested in what we just discussed, the Risk Managed Gold Index, you can find more information at www.customindices.spindices.com/IDX Insights or idxinsights.com, or simply type in the Bloomberg tickers IDX GoldX, IDX Coin, or IDX TSA. And for anyone who has specific questions, you can reach out to IDX's head of investor relations, Ben Jacobson, at benjacobson@idxadvisors.com or at 951-541-3959. Don't forget to ask about the RG Orum Plus Fund. This is a mutual fund live September 8th of 2020, and it is a risk-managed approach to gold and digital assets. The ticker is GLDPX, and Ben will answer any and all questions related to that fund. We'll be back in the next few minutes to host a live Q&A panel. Looking forward to it. Thanks.